Banks have gotten way too comfortable holding your money and paying you almost nothing for it, and then charging you for the privilege of accessing your own cash. You deposit your paycheck, you keep thousands of dollars sitting in the account, and the bank uses that money throughout the financial system. In return, you get little to no interest. And the moment you use the wrong ATM, send a wire, overdraft, travel overseas, or drop below a minimum balance, they hit you with fees. That's exactly what this combination fixes. Fidelity has quietly built a setup that can replace almost all of those jobs inside one ecosystem: the Fidelity Cash Management Account, paired with the Fidelity Rewards Visa Signature credit card, a card that often comes with a generous limit anywhere from $25,000 up to $75,000. Used together, your money can earn a competitive yield while it sits, and you earn unlimited 2% cash back on everything you buy. The Cash Management Account, or CMA, is technically not a bank account. It's a brokerage account built to function like one. You get a real routing and account number, so your paycheck can be direct deposited. You can pay bills, write checks, deposit checks from your phone, and spend with a debit card. Fidelity also reimburses eligible ATM fees worldwide, which is genuinely useful if you travel. Here's the real difference. At most banks, idle cash just sits there earning nothing. In the CMA, your uninvested cash sits in what Fidelity calls a core position. You get two choices: the FDIC-insured deposit sweep or the Fidelity Government Money Market Fund, ticker SPAXX. SPAXX is the higher yielding option, recently running around a 3.3% 7-day yield. The FDIC-insured option is lower, closer to 1.8%, but it spreads your cash across partner banks for extra protection, up to several million in coverage. It's a trade-off: slightly higher yield or extra deposit insurance. Say you keep $20,000 sitting around for bills and emergencies. In a typical checking account paying 0.01%, that's about $2 a year. In SPAXX at roughly 3.3%, that same $20,000 earns around $660 a year, about $55 a month, while staying just as accessible as before. One honest caveat: SPAXX is a money market mutual fund, not a bank deposit, so it isn't FDIC insured. Its yield can also move. Fidelity accounts are covered instead by SIPC, which protects up to $500,000 if the brokerage itself fails. But that's not protection against investment losses, and it's not the same thing as FDIC insurance. If FDIC coverage matters more to you than yield, the insured sweep option is there. Because the CMA connects directly to Fidelity's investing platform, you can automate the whole flow. Paycheck lands in the CMA, and a scheduled transfer sends part of it straight into a Roth IRA or brokerage account. Instead of waiting until month-end to invest whatever's left over, the money moves the day you get paid. Now the drawbacks: because this isn't a perfect replacement for a bank. You can't deposit physical cash directly, no branches, no cash-accepting ATMs. Fidelity doesn't support Zelle, so you may still want a separate bank account for that. Because SPAXX isn't FDIC insured, that's a real trade-off if protection matters most to you. Some budgeting apps that rely on Plaid may not connect smoothly, sometimes requiring you to enter your account and routing numbers manually. And new deposits can occasionally take longer to clear, so don't move your entire emergency fund in on day one. Start small, confirm everything works, then scale up. Opening the account is simple. You need to be a Fidelity customer, verify your identity, and complete the application online. Basic personal and employment details, nothing unusual. Now the second half. The Fidelity Rewards Visa Signature Card. Unlimited 2% cashback on eligible purchases, no annual fee, no foreign transaction fee, no rotating categories, no caps. Technically you're earning points, 2 points per dollar, redeemable at 1 cent each when deposited into an eligible Fidelity account, including the CMA itself. Redeem into cash or investments, not gift cards, or you lose value. You can even set redemptions to happen automatically. Let's put real numbers on it. Say you spend $3,000 a month, $36,000 a year, on this card. At 2%, that's $720 a year in rewards. Invest that every year in something like a low-cost S&P 500 fund averaging 8% annually, and after 10 years you'd have contributed $7,200 in rewards, grown to roughly $11,000. After 20 years, $14,400 in contributed rewards grows to around $35,000. Now add the CMA side, that same $20,000 sitting in SPAXX at roughly 3.3% left unspent for 20 years, adds up to about $13,000 more. Combine both, and this system can generate somewhere around $48,000 over 2 decades, without changing a single spending habit, chasing rotating bonus categories, or paying an annual fee. You could earn more on paper juggling 5 different cards with rotating 5% categories, but that strategy only works if you actually track the categories, never miss a payment, and consistently invest the rewards instead of spending them. One flat, unlimited rate you'll actually stick with for 20 years usually beats a complicated system you abandon after 3 months. This card targets good to excellent credit. Aim for a 720 FICO or higher for a strong shot, with 750 plus meaning your score is unlikely to be the reason for a denial. If you don't know your score, or want to understand exactly how it's calculated and how to raise it, I broke that down in detail in my first video, links in the description, and while you're there, go ahead and subscribe so you don't miss the next one. Approval isn't guaranteed even at a high score, and starting limits vary wildly, anywhere from a few $100s up to $75,000 depending on your full profile, income, existing debt, payment history, and recent applications. Before applying, get your credit utilization down towards single digits, avoid opening several new accounts at once, and keep recent hard inquiries to a minimum. If you're approved with a low starting limit, keep using the card responsibly, pay it off in full every month, and the limit typically grows over time. The real question isn't whether your current bank works fine, it's whether it's doing enough for the amount of money and loyalty you're giving it. A cash account that actually pays you, paired with a card that turns every purchase into an investment. That's not complicated, it's just underused. If this was useful, let me know in the comments whether you're already using something like this or thinking about switching.